For decades, Canadians have turned to real estate as the go-to path for building wealth. It's tangible, it's familiar, and for many families, it's been the foundation of their financial success. But here's the question. In today's market with high interest rates, rising property taxes, and tighter cash flow, is real estate still the smartest way to grow your wealth? Or could you actually come out further ahead by investing in a non-registered portfolio that generates dividends and capital gains, assets that grow quietly, stay liquid, and can often be managed far more efficiently from a tax perspective? Because the truth is, both paths can build wealth, but how they do it and what you keep after taxes and costs can look completely different depending on your income, structure, and long-term goals. Hey there, I'm David Drummond, founding partner at DLD Financial Group. I'm a certified financial planner and have been building financial plans for clients since 1999. And in this video, we're going to break down the real comparison between real estate investing and non-registered investments, looking how each performs when you factor in taxes, leverage, liquidity, and long-term growth. If you're a business owner, professional, or investor trying to decide where to build your next stage of wealth, this will give you the clarity you need to make that decision with confidence. Before we dive in, please don't forget to like this video, subscribe, and if you want to see how this applies to your own financial plan, book a time with me using the link in the description below. All right, let's take a closer look at how real estate and non-registered investing really stack up when it comes to building long-term after-tax wealth in Canada. Okay, so what I'm doing is I am going to walk through one of my sample plans we've put together here. And in this plan, I am going to go through the assumptions. So we've got Jane and John Smith here. I'm going to put my glasses on. Okay, so we've got Jane and John Smith here. And in this example, we're going to use certain assumptions. 3% inflation, everything we do in these plans is conservative. So high inflation, low returns. Our maximum returns within the plans themselves are 6% for equity returns, typically 4-ish for returns in retirement. We have portfolios that have done much better than that, given those asset allocations, but we're certainly wanting to be conservative. We also assume people live to age 95 for a bit of a buffer there as well. So you can see here, this is a family of 4. Jane and John Smith, age 52 and 57, with a couple of children that are 22 and 19. We've got incomes here. These are indexed for inflation. Jane's making 190 and John is making 105. And that is going up with inflation at 3% until retirement. Retirement ages are here, expenses, pardon me. So we've got expenses at $5,000 a month currently, with $11,000 at retirement on a monthly basis. These are after-tax numbers indexed for inflation as well. So the accounts that are linked towards helping them with the retirement goal are here. There is a number of different accounts from TFSAs, there's some company stock that they work for. There's a family RSP that's getting drawn down as one of their children is in university. The RRSP, the spousal RSP, the non-registered accounts, there's some saving components here between about $500 up to $2,000 a month, depending on the portfolio. And John has some assets as well that are being saved to on a monthly basis between $1,000 and $2,000 a month. Of note is the inheritance on the bottom here. It's a joint account. Came in to the family a few years ago, just over $900,000 as a cost base, and this portfolio has now grown to $958,000. And this is a typical scenario that we'll see as financial planners, and people will ask us, do we take that $900,000 and change and purchase real estate that's going to kick off some revenue? And so that's the purpose of today's plan is to look at what's the difference. What does it mean to the estate? In my mind, it's at this point, you'll see that the cash flow is really important. And so what does that mean to cash flow? In other words, the question we're looking to answer here is, do we leave these funds in a non-registered portfolio, which is liquid and is earning about 6% pre-retirement, 4.2 post-retirement. The returns are in a corporate class structure. Corporate class is a vehicle that allows for uh, deferment of most, if not all, growth on the assets inside the portfolio. And in when they do come out, they come out as capital gains or dividends, which are taxed at a much lower rate than any interest-bearing vehicles. We do have some interest allocation within this portfolio at retirement to ensure that we've layered or layered or laddered, whatever you prefer, uh, the the portfolio so that there's 2 to 3 years of cash ready for buffering against market fluctuations, and then the rest is allocated to bonds for another 2 or 3 years of income, and then following that, the rest is in equities. So, um, this portfolio again that I'm highlighting here is the one that we're going to be working with as a comparable, and so 958 in this recommended plan. I have to create two plans, and we're going to call the one that's in right now the recommended plan, and you'll see why. The recommended plan has the 958 growing at 6% with some deferral and tax planning, as well as 4.2% in retirement. So, just to come back to some further assumptions that aren't as relevant in my mind, but certainly should be discussed. We've got a paid off place at Whistler here and a home. The home is worth $5.3 million. We index these at 2% for inflation. We've got a mortgage of 3%. That'll go up when it renews. But 3% was a great rate, obviously. The mortgage is almost 800,000 with a payment of 5,200. So a little bit accelerated. Um, so how does this look? Well, we are going to go into planning, and you can see here we've got a number of different charts, and I'll be putting some side by side for comparison's sake. So you'll see here that we have uh, available investments. So we'd like to start with this. This looks at all those assets that I itemized in the accounts and how they stack up in terms of driving retirement income scenarios. And it's pretty good. You can see up here, this score is showing it as good for retirement scenario. I mean, there's some things we can do. We often get questions about what if we delay CPP or OAS. So, I've added these, just these are minor changes. You can see if we delay CPP for both individuals to age 70, that does increase the income scenario by 3.4% and OAS 0.8%. So, how does that change the graph? You can see here, there's a little bit of a bump. Um, so, based on their assets, it might make sense if they're both in good health to make that change to their government benefits. Situational dependent at the time, I would say. So, we like to look at this graph, and we'll come back to this. But what I'd like to do now is focus on stack net worth. We can do this on a graph or on a table. I tend to like working with tables. People when they see numbers, they too many numbers on a graph, their eyes roll into the back of their head. So I like to work with these graphs, and they show the whole family assets as broken down. We've got a lifestyle asset here, which is the property in Whistler and the home in Vancouver. And we've got registered assets, so those are being drawn down starting at retirement. We've got TFSAs, and small amounts, relatively speaking, in big picture. Then we've got a non-registered component of the portfolio or the net worth. And that's the one that's going to be changing when we add in the purchase of a revenue property as a comparison, right? So liabilities, we've got a mortgage. Okay. So if we look at this timeline here, we've got retirement at the same age and CPP, OAS. They're all start at the same time. Just for simplicity's sake, we can adjust if necessary. But the second thing that happens here is, okay, OAS is starting later for Jane, but we've got the mortgage paid off in 2040. Uh, do we pay that off more aggressively? That's another video we've got. We'll use the same plan, and we'll address taking money out of a non-registered portfolio in order to pay down a mortgage. Does it make sense? And does it drive the net worth differently? And we can side by side comparison, right? So we do a lot of this type of work It's quite eye-opening. I mean, again, we don't sit there and say, this is what you should do. We just go, look, here's what the numbers, on a conservative basis on returns, and inflation, and after taxes is what things would look like if you did this versus that. So, um, I will jump into, the scenario, which is, do we buy? The question we'll often get is, should I take that 900,000 and buy a revenue property? Because people have made so much money, especially in Vancouver, purchasing real estate. It's been a huge phenomenon over the past few decades, in Canada, to such a degree that in many cases, business owners, statistically, business owners have put, more money into real estate than their own business in some cases, which has, dropped productivity in this country. And they've done well by it. But it doesn't make sense now. So this revenue property, that I'm putting together here in terms of, okay, so we've seen how things look for them, again, just as a comparison. Good income. There's some options there we can touch on, and we've seen their net worth. Um, Net worth at life expectancy is just under 27 million based on conservative assumptions. So let's say they take, the 900,000 and change and use it to purchase a revenue property. What does that do to their retirement income plan? So here we are. I'm clicking on buy a revenue property. Right away, you'll see, that the net worth is, in the neighborhood, yes, about the same amount. We do have some issues. You'll see an increased liability because we're buying a $2 million property with a $900,000 down payment. So that mortgage is going to be, although it's tax deductible, it's certainly, it's going to be in there. And then you'll see here that this is creating some liabilities later, and this is short cash shortfall. So I'll come back to that and why that exists. So when we look at the details of this property, we can go in here and it's build a strategy in this software. And effectively, I can go down and see, let's start with what we purchased. Well, we purchased a $2 million property in Vancouver, and the growth rate is 2%. And we've put a $900,000 down payment. Some important information here is income. So you can see here that the rental income is 5,000 a month, and the rental expenses, I'm not sure if this is, I spoke with a realtor friend this morning, and we just want to be conservative. We looked at, strata taxes and maintenance. It's 1,200 a month. So those are additional costs, that go against the revenue. So that's accounted for. And taxation of, the revenue from this property is fully taxable. So it's not coming in the form of capital gains or dividends. It's similar to salary. And with their tax rates, it's going to be near or at the highest marginal rate, near 50%. So, we've got this scenario. And then if we go back to, the expenses, the liabilities, you can see here, yeah, there's the two mortgages, which is, this is the home and this is the $1.2 million mortgage at a higher rate. Revenue property rates have gone up. It is tax deductible, so we've accounted for that interest being tax deductible. The payment is 66.42. So, um, expenses have already been accounted for. So, let's go back, and so you've got a good idea of $5,000 of revenue, less 1,200 expenses, and then you've got a mortgage of 6,600. So, if we go back to the plan, you can see that because of the use of leverage on this piece of property, we've got a significant, net worth that hasn't really been affected. Either situation, whether you leave the money in non-registered account, or, and you draw that down, or you leverage and take the income off of the property, the net worth really stays the same, um, but the income suffers. So if we go over here and we look at the available investments to drive the income, you can see here, this was the original plan, leaving the money invested in a corporate class structure, or a structure that has a significant capital loss, anything that's tax effective in terms of driving income, and deferring some or if not all growth at 6%. So we've got this, creating a good income for the family in retirement. But this line illustrates what happens if they purchase this revenue property and basically their income drops. You can see the withdrawal of that 900,000 or reallocation, let's say, into a revenue property changes the growth curve of the investments and it draws it down in this manner. So, and you can see here this is reflected in the fair score that they're now receiving for their income. I'm going to go into audit reports and show. Um, I'm going to show in audit reports the comparison here. So I've got the income uh, summary projection side by side. This is real estate purchase. So you can see this redemption, the withdrawal of nearly 1 million, and then it's allocated to the revenue property. And you can see that things move along in this manner from an income standpoint, but we do have a shortfall, and that is starting in year 2062. And it's a shortfall in today's dollars at 224,000. Whereas if they leave the funds allocated to the portfolio that it's currently in, and we're allocating only 6%, we're done much better than that. But if we're conservative and we defer some of that growth, and when it comes out in capital gains or dividends, uh, you're looking at an income that's definitely not. It's not real. There's no shortfalls here. In comparison, what does it do for? So that's income. Now let's look at net worth. How does income look? Sorry, net worth. Net worth. So when I compare net worth projections, this this is reversed actually in this scenario. Just so we're consistent, I'm going to change this to recommended, and this one to so it matches what we were how we were lined up before. You can see here, there's the shortfall, the liability. There's the additional mortgage, and on top of not purchasing, comparison to not purchasing, you can see here the net worth subtracting liabilities is the same, right? It's 20, almost 28 million, and this one is it's 27. But at that stage, we're pretty conservative on these assumptions. It's going to be about the same. So, what you're seeing here is a much larger allocation to real estate. We've got lifestyle assets and rental properties. Okay, registered assets, TFSAs, and a little bit of non-registered. The liabilities column there, and then if we look here, lifestyle assets as a proportion, real estate that is lower. Registered assets, similar. TFSA, similar. Non-registered, that's the difference. We didn't make that big withdrawal. Okay, so that's really how it stacks up. Now, some of you might be saying, what if we changed the revenue on this? And this was the discussion this morning with a couple of my friends that work in real estate. So what if we change the revenue to 7,000? Which some felt was more in line. And what does this do to the plan as a whole? So I'm just going to save that change and I'm going to move back. You can see, yeah, it's slightly better. We're still fair. We're stretching the elastic band here pretty significantly. So yeah, it looks better, but it's still. I wouldn't be comfortable with this plan. Recommending this plan, I would say that to these individuals that you really pushing it, and I wouldn't want to see you in that situation. But if we go back to these audit reports once again, and we look at net worth, it's really going to be similar, right? 2027 and 2020, almost 30 million. And then income is going to be somewhat different. Less liabilities if you're able to get that amount, the 7,000 a month. But you're still having a little bit of a shortfall here. And so that is a comparison. My hope is that I've illustrated, the thing with real estate is it tends to lock up deferred capital. And it's great. Like if this family wants to leave another piece of property to their heirs, that's a great goal. But if their goal is income security and liquidity, So it's not what's right, it's what's right for those people and their priorities. I would argue that, and it's clear here that you have more liquidity, more, and partly it's due to more tax planning associated with the vehicle in the non-registered portfolio being deferred, most, if not all, income. But I also wanted to, while we're on this topic, look at what else we could do here. What if we wanted to retire sooner? Um, so if I put in here retire sooner, and I'll lay this out. We go, what do we go? We said 5 years earlier, retiring at the same time, so that you can see here that it shows almost 22% decrease. That's a shortfall. Even if we leave the money invested in the non-registered portfolio, you're still having a shortfall. So what do we do? Oh, well, we can delay CBP. Okay, well, that changes it, right? Delay OAS. Okay, it changes it a little bit more, but it doesn't really make a dent. So what we get into sometimes is discussing the downsizing to a less expensive home, say 15 years into retirement. And this is common uh, simply because as people get older, they travel less, their medical expenses are higher, they maybe want to move to a condo or possibly assisted living later in life. So this is something that we often talk about with people, especially if they really want to retire at a certain age and they want to feel comfortable that they can get it done. Then we look at downsizing. And in this case, we've got retirement plus 15 years. So in other words, stay in the house for 15 years after retirement and sell it for a price of, this is an indexed figure, with today's dollars, 5.3 million, and the cost of the new home in today's dollars is 3.1. So you're pocketing just over $2 million, which you can see here. This has been illustrated as coming into non-registered portfolio to assist with the driving income. So you can see that takes care of the issue of a shortfall, and it's quite common to discuss this. It happens almost frequently, very frequently. Pardon me. It happens very frequently. So yeah, I hope that this gives people an idea of whether or not it's not a question of. My hope is that we've provided some examples of what the purchase of real estate can do, and albeit there may be some arguments over some of the assumptions that we've used, but the reality is that we can adjust those assumptions on the fly, as you can see here. When we build these plans, the idea is to provide facts. People can adjust as to their emotional needs, but we can at least provide a bit of a roadmap as to what decision making where will land you. And so, yeah, hoping that that has driven some interest and giving people an idea of the type of work that we can do for individuals that have these types of questions. Frankly, really enjoy this type of work, building these plans. They can be less or more complex depending on people's situations. So here's the real takeaway. Both real estate and non-registered investing can be powerful tools for building wealth, but the best choice depends on your income level, tax situation, time horizon, estate goals, what you want to leave for your heirs, and how hands-on you want to be. Real estate can give you leverage and stability, but it also comes with maintenance cost, market cycles, limited liquidity, and in the case we reviewed, lower comparable income. Non-registered investments, on the other hand, can deliver dividends, capital gains, and flexibility, especially when structured to take advantage of tax-efficient growth. There's just no single right answer. The key is understanding which approach aligns with your goals, your lifestyle, and your long-term retirement plan. Really love to hear your thoughts in the comments. Do you lean more towards real estate, or do you prefer the control and flexibility of market-based investing? And if you're unsure which path fits your wealth plan best, book time with me using the link in the description below. We'll walk through the numbers just like we did today, compare both strategies side by side, and build a plan that helps you grow your wealth efficiently, not just in theory, but in real life. Because the smartest investors don't just choose between real estate or the market, they structure both to work together in a way that maximizes long-term after-tax wealth. If you liked the video today, please subscribe, leave a comment, and I'll see you in the next one. Take care.